Hello, my name is Michael Scott Forehand. I'm with I'm a regional agency director here at Symmetry Financial Group. Today is April the 20th, 2023. It is 5:37 p.m. East Coast time. This is our debt-free life program that we're going to be teaching people what the program is, how it works, show some graphics to help illustrate that. And then we're going to have kind of a roundtable discussion for advanced concepts about different ways that you can use these infinite banks and these infinite banking strategies. And we'll talk about that. I don't have a special guest here today. I actually had intended to contact either Scott Simpkin or Bruce Slingo to be the special guest for today. And as it turns out, they both got my mental message and they both showed up. So we're in good luck, everybody. We've got we got very lucky. So congratulations. Thanks for showing up, guys. Thanks for getting my mental message and being here to support this event. So let me go ahead and get this program started from the beginning. So now I have to go minimize this and share my screen and share that screen. And hey, voila, did I do it right? Did I get the technology right? Do you guys see my debt-free life? Okay, so let's get going. So what is debt-free life? So debt-free life is a proprietary product that's offered from Symmetry Financial Group. This is designed to be a debt elimination tool, as well as a wealth growth tool, as well as be a generational wealth creator, as well as being a tax-free retirement income solution. Yes, I said tax-free. So let's move forward and let's get a little bit deeper into what this thing is and how it works. So when we first start these programs, we ask people two questions. The first question is, are you 100% certain that you're going to have a solid retirement? And the second question is, if we could show you a way to get out of debt in 9 years or less, would you be interested? And of course, nobody ever answers the second question, no, I don't want to hear about it. And of course, unless you are your own financial advisor and you never make mistakes, of course, you're not going to be answering that first question, are you 100% sure, as in the affirmative. You're gonna have some doubt. So what we try to do here is we try to get rid of those doubts, try to get rid of those questions, and show you conservative, accurate, guaranteed performance vehicles that will get you to where you want to be. All right, so here's how this works. Most Americans that we talk to have some debt. Most Americans are in the situation that you see on your screen right now. The average dollar that you make, 23% of it goes to pay for your lifestyle. That's paying your bills, putting food on the table, paying your rent, paying your Hulu bill, putting gas in your car. That's the daily living expenses. About 40% of every dollar you make goes to pay taxes. And this, I mean, for me, this is not the American way. This is not the way it's supposed to be. We are taught how easy it is to get into debt, and even encouraged to do so by the banks because it's in their best interest to get us into debt. That's why about 34 cents of every dollar we make is spent on interest service. And then finally, the average American saves about 3% of their income for retirement. And the problem with that is, if you think about it, if I'm making $100,000 a year and I'm saving $3,000 a year for retirement, and I do that consistently year after year for 20 years, in the end, I've only got $60,000, but I'm used to making 100. How long is that 60 going to last me? That's the problem. And when we talk about or think about the history of the country and where we were, the current retirement models were based on the notion that there would be three pillars of retirement income. There would be a Social Security pillar, there would be a retirement savings pillar, and there would be a pension from our employer. Unfortunately, as we've moved forward in time, the pensions from employers have died. So we are left with a two-legged stool. Anybody ever tried to sit on a two-legged stool? It doesn't work well. So that's why these problems aren't working well these days. So what our goal is, when we look at the average American, we make $2 million in our lifetime. That's a lot of money, okay? But again, that problem, which is the math we just did a second ago, we only save about $60,000, and it's not going to last long. It's certainly not the American dream. So let's say we realize that there's a debt problem. Let's say we realize that I'm making $2,000 a week, but I'm spending $1,800 a week on my debt service, my credit cards, my personal loans, student loans, car loans, back taxes, medical bills, mortgage, rent, whatever, it's not tenable, and it's not tenable for very long, at least. So sometimes we have this opportunity where we go meet a debt counselor or a credit counselor, and we ask them what to do. And those bullets that you see on your screen are the common responses from a debt or a credit counselor. Those people mean well, and they're good people, but the problem is the solutions that they have, unfortunately, don't work most of the time. They sound good, they look good on paper, but let's be real. If you could work harder and make more money, wouldn't you already be doing it? If you could spend less money, wouldn't you? If you could save more money, wouldn't you already be doing it? Let's talk about refinancing for a second. So what does that mean? That means I'm going to take a bunch of my debts and exchange it for a bunch of new debt. That's refinancing. Does that make any sense? Does it work? It doesn't. Okay, well, let's consolidate. Well, what does that mean? That means I'm going to take my collection of smaller debts, which I, in theory, could pay off easier because they're smaller, and I'm going to put it into one larger debt, which is going to take me a lot longer to pay off and more difficult to pay off. So does that work? Most of the time it doesn't. So finally, that last thing that we talk about, debt snowball. And I'm not going to use the gentleman's name, but his last name ends in Amzy. And what he talks about is actually not a debt snowball. What he talks about is actually a debt stack. And it's an inferior methodology to eliminate debt. A true debt snowball works. And that's one of the things that we use here in our approach to get people out of debt. We use two different pieces. We'll talk about them as we move forward, but one's called a debt snowball, a true debt snowball, and one's called an infinite bank or a private bank. All right, so let's move on. So our better way, getting you out of debt without you spending any additional money, that's a key here, right? Why? Because I know that if we structure a program for you that's going to get you out of debt, but I'm going to say, look, we're going to get you out of debt, but you got to spend $1,000 a month more than you're spending right now. If you have the capacity to do that, how long are you going to do that? Not long enough, right? So this has to be something that's affordable, and it has to be something that is within your means and something where you're not going to feel any pain. So when we structure these programs, our goal is to find places where you're spending money already inefficiently and repurpose it for a dual purpose. One is elimination of debt, and two is creation of wealth. And that's so it does both at the same time, which is why I love this program. So here's what we want to do. We want to move you from the left side of your screen, where you're saving only 3% of your income, to the right side of your screen. We want to change the amount of money you're going to pay for taxes from 40% of every dollar to 30%. Is that a 10% reduction? Nope. That is a 25% reduction in the amount of taxes you're going to pay over time, right? The federal government, they make plenty of money and they spend way too much money. So if I don't have to spend or pay them as much money as I'm paying right now, sign me up, as long as it's legal, which this is. If I can reduce the amount of interest I'm going to pay over time from 34% to 22%, on the surface, that looks like a 12% reduction. It is not. The way the math works, that's actually a 43% reduction in the amount I'm going to pay over time for interest. What happens to the money that you spend for interest? It's gone forever, right? What happens if I'm keeping that? That's 43% more money I'm able to keep that I'm able to use for retirement. Lifestyle. This is that question we talked about earlier. Okay, if I force you or put you into a situation where you have to spend more money, you're probably not going to complete the program. But what happens if I put you in a situation where you've got even more money to do lifestyle stuff, right? All of a sudden, you're scraping your money together to pay your Hulu and your Netflix bill, but now I've just increased your income by 11%, which is actually a 20+% rise. Is that really going to allow me to have a problem with my Hulu, my Netflix bill? No. Now your problem is going to be, which cruise am I going to take? Which flight am I going to take? Am I going to take a direct flight and pay more money, or am I going to take that one with 2 connections? Now you have choices, right? That's what we want to do. We want to put you in a situation where your cash flow is increased so you don't feel the pain, okay? Let's move on. So how do we do this? We reduce the amount of interest you pay to other people. We eliminate all, not some, not most, all of your debts in 9 years or less. And let's talk about that statement for a second, because what I've done I've done hundreds of these programs. I've planned thousands, but I've executed hundreds, really, probably 400 or 500. And the ones that I've executed, that number, 9 years or less, it's accurate, but there's a difference. It's actually 15 to 27 years sooner on your debt plan. So whatever you're doing right now, whatever your plan is right now, we're going to, using this program, we're going to get you out of debt 15 to 27 years earlier than you're already anticipating, especially if you have a 30-year mortgage. We're going to reduce the amount of taxes you pay over time. We're going to increase your cash flow. We're going to allow you to retire with a tax-favored income, right? So let's talk about tax-favored income. Is a 401k a tax-favored income? Nope, it's not tax-favored, it's tax-deferred. Okay. Is a tax-exempt retirement a tax-favored income? Well, in my opinion, that's the most tax-favored income of all kinds. If I can take money and not have to pay tax on it whenever I want, wherever I want, for whatever reason I want, without having to prove to somebody that I need to do it, sign me up. That's what this is. We create a private bank or an infinite bank with those specific pieces. And more importantly, you see that 15% number at the top right-hand corner of your screen on that little pie chart? What does that mean? That means that we've increased the amount of money you're saving for retirement from 3% of your income to 15%. And we've increased your cash flow, and we've reduced the taxes you're paying, and we've reduced your interest. So we've changed the game. We've put you in a situation where you're spending money and saving money more efficiently. Okay. There are a number of these programs that are out there. They call them all different things. There's lots of companies out there that use different products for these. I'm a firm believer in one particular kind of product, and we'll talk about that. But there's a common reason why those other programs that are out there fail. And the reason why is because they don't plan for the unexpected event. It's great if I can keep a program in place. It's great if I can fund it properly. It's great if everything works exactly to plan. But if there's anything all of us know about life, is that life doesn't always go to plan. Things happen. Life happens, right? You may lose your job. You may have to move and take a lower job. You might have to move to Texas from Maryland. Who knows, right? Different things happen. And the idea is we want a program where those things that happen from a just regular life perspective are not going to negatively impact my ability to execute this program. So what we do is we hide money. What does that mean? That means that all the money that you see in the program, it's there and it's real, but there's about 20% more that you don't see that's there for an emergency. Okay. What do I mean by an emergency? I don't mean you need to take an emergency trip to Tahiti. I don't mean you have to go buy a new snowmobile. I don't mean you need a new ATV toy. I mean, my brother-in-law just lost his job. He needs $20,000 or they're going to foreclose on the house. That's an emergency. I mean, my mother just got diagnosed with cancer. She can't work anymore, and she doesn't have the money to travel to Johns Hopkins to get treatment. I'm going to pay for that. I need money. That's an emergency. So the idea is those things that happen, we want to plan for them. We don't want to be in a situation where we have to use the money, but we want the money there if we really need it. So that's why the program that we do creates a fund, a secure fund of about 20% more than what you actually see, that if you have a real emergency, you can get to it. Now, here's the thing about that emergency. If you get to it, that's the end of the game. Because if you're executing that program to access that 20% emergency fund, that means you're closing out your program. So you can only do it one time, and it better be a real emergency. All right, so let's talk about this from an investment perspective. So if you take the same kind of investment and you put it in a tax-free program, which is what ours is, versus a tax-deferred program, which is what a 401k is, or a 403b, or a KEO, or a SEP, or a TSP, or a FERS, or you put it in a taxed program. That's where you're just going to put it in, say, a savings account. If we use the same parameters for each one of these particular types of retirement investments, same unit size, $10,000, same length of time, 28 years, same compound interest rate, 7%, same tax rate. Does anybody think that most people are going to be in a 25% tax rate when they're touching their retirement? And does anybody think that they can find an IRA that's going to give them a 7% average gain? Not really. Okay. So let's be real, right? So, but if we could, this is how the numbers would flesh out. So really what I'm looking at from a perspective of, can this system or can this program exceed what I'm going to do in a 401k? Hands down, yes, especially depending on your age, right? These programs are great for young people. They're even better for people that are closing in on retirement, because if you're looking at a retirement vehicle, the number one problem that you have as far as getting to retirement and getting to your retirement money is your debt. So we need to eliminate your debt as quickly as possible. A 401k is not going to help you do that. We also want to put money in this program that we don't ever want to have to pay tax on it again. This is in the investment strategy side, this is called a non-qualified program, which means I pay tax on the money after it goes in. And when I pull money out, I don't ever have to pay tax on it again. So this is a financial instrument. Like all financial instrument, it works in phases: maximization, accumulation, distribution. The maximization phase is getting us to the point where we're putting the most amount of money possible into our retirement program. That's all it means. So if I'm starting off at $50 a month, that's great. But let's say I want to get to $2,000 a month, but I can't because I've got $1,900 a month of debt service that I'm paying. The sooner I eliminate that debt service, the faster I'm going to get to that point where I am socking away $1,900 a month for retirement. Accumulation. That's the middle section. That's the point where you've eliminated all your debt, but you're not ready to start taking distributions. You're not ready to start taking money from the program. So that accumulation phase is when we've reached the pinnacle of how much we're going to put in on a monthly basis or an annual basis, but we're not ready to start taking the money yet. And then finally, distribution. That's when we can take that emergency trip to Tahiti. I can go buy that emergency snowmobile. I can go buy that new ATV because I want to go hang out with my buddies, right? That's the distribution phase. It is your money. Don't have any illusions. It's your money, and you're the only person who makes a decision of whether or not you get to use the money, right? So let's move on. This program is not new. This program has been done for a very long time. The first person that ever did one of these that I can find is actually John Rockefeller, who did one of these back in 1904. Okay, it wasn't called a private bank. It wasn't called an infinite bank, because those phrases were coined in the 1960s and 1980s. It was simply called life insurance. Okay, and that's all this is, folks. This is a specialized type of life insurance. I'll explain that in a second. And these people have used these programs for different reasons. This tool is a Swiss Army knife financial tool. You can use it for just about anything. You're limited only by your imagination. Walt Disney used this because they wouldn't let him borrow enough money to build Walt Disney World. So what he did was he leveraged money in a life insurance policy, borrowed against it, spent it, did dollar cycling, borrowed against it again, spent it, and that's how he funded the construction of Walt Disney World. Doris Christopher did it with Pampered Chef. Ray Kroc funded his first 11 units of McDonald's with this program. Again, for Ray Kroc and for Walt Disney, wasn't called an infinite bank, wasn't called a private bank, it was called life insurance. And then finally, to this day, Warren Buffett does it. And this is just a group of people. J.C. Penney did this. He used it for a completely different reason. He used it because his employees were seasonal, his business was seasonal, but he wanted to not have to fire his employees. So he created a business version of this program where he could take money out in the lean months so that he could keep his employees employed, and socked money away in the busy months so that he was building up that nest egg. Same kind of thing that construction companies do, where in the wintertime, they're using money that they stored up in the summertime so they can keep their business rolling. Same kind of deal, all right? These are bonuses and benefits of how we use the policy. One thing I want to say, it's not here as a bullet point, but I want to make this point very clear. This is the only investment of this kind on the planet. This is the only investment where you can invest money into a program, earn interest with it, and use the money at the same time. And what I mean use the money, I mean if you put $10,000 in here and you take $5,000 out, that $10,000 is still in here. You're not taking your money, you're not taking your principal. That's the beauty of this program. You get access to about 95, 96% of your cash and you can encumber it, but it still earns interest even after you encumber it. let's paint this picture. This is a really interesting statistic. My net cost of money from here, because I have a half a dozen real estate clients that use this program where they're actually using this to buy and flip houses. When they go to their local bank and they take a hard money loan from their local bank, they're paying between 8 and 12% interest for a short-term loan. In this program, they're paying a net 1.7% interest. And that number fluctuates, but that's the ceiling so far. So this is a no-brainer if you've got a business like that where you're going to cycle through your dollars. Okay, let's keep going. So when we first started this program about 5 years ago at this point, these were some of the first groups that we worked with, some of the first families. This was originally the way we structured these programs. This was designed to eliminate family debt, to get rid of the number one problem facing this country right now, which is debt. If you looked at the debt clock recently, I think we're up to $33 trillion right now, and it's not slowing down. So if we have an opportunity to eliminate client debt, which we do using this program, why shouldn't we? Especially if it eliminates debt, creates wealth, creates tax-free retirement, and creates a legacy. It does all those things at the same time. This is it's a pretty powerful tool. All right, so let's talk about how it works. In order to understand how the program works, the first thing you have to do is understand how you spend money. And also remember who taught you how to spend money. Okay, let's not lose sight of that. So the first thing is, let's say you make money. Great. We're doing whatever you do, whether you're a 1099, whether you're W2, W4, whether you get royalties off a book you wrote, who knows? It doesn't matter. You make money, right? You take that same money and you deposit that money as income into your bank. It doesn't matter who you bank with. They all work the same way. So you put the money in the bank, and then your money is sitting there, and then your bank makes money with your money. Your bank lends your dollar. Every dollar you put into the bank, your bank will lend it out. The average is 7 times before you actually get to use that number. 7 times, right? So what does that mean? That means the average dollar that you put into the bank makes 61 to 69 cents for your bank. And let me ask you this. How much do they pay you of that 61 to 69 cents? How much do they give you back? And if you're lucky, you might get 0.25%. But most people get 0. Most people, the best thing you get from your bank is, hey, look, because you're keeping at least $2,500 in your bank account, we're not going to charge you a fee to keep your money in our bank and let us use your money. That's what they're really saying. Okay, so let's be real, right? So if I know that that's happening, the average dollar's earning my bank 61 cents. That's the very definition of what we're trying to do here, which is called arbitrage, folks. Arbitrage means I can borrow money at a lesser interest rate than I'm able to use it and lend it out at, right? The bank is borrowing it from us at 0%, lending it out at the federal funds rate or higher. That's it. That's how they make money. Next, I tell my bank to pay my debt. And then what happens? My money has become their money. I have used my money exactly 1 time. My bank has used my money 7 times or more. In this scenario, who's winning? Right? It's the bank. And who taught us how to spend money this way? The bank. So that's why this is called a private bank or an infinite bank. What we're trying to do is put ourselves in a situation where we can have our money, earn money with our money, and use our money all at the same time. That's the definition of our private or infinite bank. In this scenario, I used my dollar exactly 1 time. So if we're talking about a car here, for example, let's say I needed to pay off my car and I owed $1,000. If I transferred $1,000 of my cash into my bank, and then I told my bank to pay $1,000 off on my car, then I've transferred $1,000 of my cash for $1,000 of increased equity in my car. My gain is 0. I've traded my dollars 1 for 1. I have 0 gain. The only entity that gained in this scenario was my bank, who got to lend my money out and make money with my money. Okay? There's a better way. And here's the better way. This is our debt-free life way or our infinite bank way. Nothing changes about how you make money. Nothing changes about what you do with the money. It gets deposited into your bank. Here's where the game changes. Instead of letting the money sit in our bank account and letting our bank use that money over and over and over and over again without paying us anything for it, we're going to take a pit stop. We're going to send some money from our regular checking account and we're going to pay our life insurance premium. These programs, the way that we do it, they're built on whole life. You can build them on an indexed universal life. Bad idea right now with the down market. You can build on home equity line of credits. It's impossible to pay off a loan for your home with a home equity line of credit. By default, you're encumbering your home again. And there's a couple other pieces. All of the other programs will fail eventually. This one doesn't. It's permanent. Permanent cash value, permanent growth, permanent. So I pay this money. Let's say it's $1,000. Okay. Let's make it easier. Let's say it's $100. Okay. So I spend $100 for my whole life policy, right? The premium hits my carrier. And the carrier says, wait a minute, here's $100, but you have a whole life, but it's not all going to whole life. You've got a term rider on this too. Yes. Why? This gets to the IRS tax code that governs these programs. IRS tax code 7702A says, if the life insurance value of a life insurance policy is exceeded by the cash value of the life insurance policy, then that policy is not considered life insurance. It's considered a modified endowment contract, and it is now a taxable endowment vehicle. So our goal when we structure these programs in most cases is to avoid that. We want to keep these, it's called a MEC. We don't want to make these MEC. The way we do that is we have a large term policy, a large term rider. That term rider acts as an umbrella so that the IRS cannot touch, tax, or see this. Okay, it's a very large amount, and it allows us to grow the cash value underneath this program fairly quickly without ever having any IRS taxation issues. Finally, the third part of that $100 that I sent in, and this is the majority of what we send in, is actually structured as paid up life insurance. So paid up life insurance is considered, it's a permanent value product. If I have $1,000 of paid up life insurance today, how much is it worth tomorrow? $1,000. How much is it worth a year from now? $1,000. How much is it worth 10 years from now? $1,000. How much money did I have to spend to maintain the value? Zero. So I have a permanent value product that never loses value, and I don't have to spend any money to maintain. The banks understand what that is. That's called a tier one asset in bank parlance. What that means is it's the safest kind of investment, which is why there's no illusion as to why banks use life insurance as part of their budgeting for how much money they can lend. If they have, like PNC Bank does, $18 billion of bank-owned life insurance on their books, that's $18 billion of secured loan capacity. So they can lend out $18 billion because they've got $18 billion secured by these life insurance policies. Banks buy these policies as fast as they can find them. Just in interest of full disclosure, there are companies called viatical settlement companies whose sole job it is to go out and find people with life insurance policies, paid up or not, and get them to assign them to a new beneficiary and pay them pennies on the dollar of what they're worth. You probably heard the radio ads, hey, if you've got a life insurance policy worth $100,000 or more, don't cancel it. Call us first. It's probably worth money. J.G. Wentworth, right? It's probably worth money. There's a couple of them, doesn't matter. The point is that they're going to try to buy this policy. If the policy's got $10,000 of death benefit value, they're going to pay you $100 for it. So from a consumer perspective, hey, you're going to give me $100 for something I was going to cancel? Here you go. I'll take the money, right? From the consumer's perspective, it's a no-brainer. And then I'm going to pay you $100 as the viatical settlement company, and now I'm going to sell this to the bank for $1,000. The bank says, okay, great. I've got $10,000 of secured asset. Only cost me $1,000. That's a $9,000, 90% gain. Sign, or 900% gain. Sign me up, right? That's what they do. So I've taken this $100, going back to the illustration you see on your screen. I've taken this $100. A portion of it's going to whole life, about 21%. A portion of it's going to term rider, about 11%. And about 70%, the balance, is going to paid up additions, which is cash growth. The carrier says, okay, look, you just gave us $70 for paid up life insurance. That's worth $70. We're going to give you $70 cash value. Aha. But the IRS says, wait, you just bought $70 of life insurance. That's not cash, not taxable. You just bought $70 of life insurance. Okay. So if you do this over and over and over again, then you get this nest egg that builds quickly, right? And then instead of the bank making money with your money every night, like it was in the previous illustration, what's happening now? The bank doesn't see the money. It's not in your checking account anymore. It's now in your private bank, your DFL bank. And then you're earning a guaranteed interest rate plus a dividend, depending on the carrier that you use. Sometimes the guaranteed interest rate is compounded monthly. Sometimes it's compounded annually. The dividend, depending on what your carrier uses, annually. This is a no-brainer. I'm going to have my money. I'm going to be liquid. I'm going to be able to get to my money anytime I want. I'm going to earn interest with it. And when I take the money out to use, I didn't really take my money out. Why is that? That's because this is how you access the money. I take a loan. So when you bought your house, did you pay income tax on the loan that you used to buy your house? Nope. When you bought your car, did you pay income tax on the loan that you used to buy your car? Nope. So if you're taking a loan from the cash value of your life insurance policy, do you owe income tax on it? No. Just like if you take a loan from your IRA, you don't owe income tax on it unless it's forgiven. Okay. So the point here is that I'm able to access the cash value of my policy. I'm able to access it anytime I want because I'm the banker. I own it. I can say, yep, I can go ahead and lend myself $70,000. Okay. And then 3 days later, $70,000 appears in my business, in my checking account. And then I can say, okay, Mr. Carrier, send the money to my checking account. My bank sees the money appear, they get all excited. And then I tell my bank, no, go pay my creditor. And then my creditor says, oh, thank you for the money. Does the carrier care what you do with the money? They don't. It's your money. You can do anything you want to do with it. Does your creditor care where the money came from? They don't. They just want to get paid. The only individual or entity that cares here is your bank, because your brick and mortar bank doesn't get to use your money every night. And you get to use your money every night and earn interest with it. This is a better way of spending money. It's a better way of saving money. And remember what I said earlier, this is the only investment on the planet where you can have money in an account earning interest for you and use it at the same time. And when you use it, it doesn't stop the interest that you're earning. Let that sink in for a second. Even though I'm taking a loan for $1,000 against my $1,000 that I've got in my bank, my private bank, and my infinite bank, my DFL bank, I'm taking a loan for $1,000. $1,000, as I take that loan, that $1,000 is still in the bank. It's still earning a guaranteed interest. It's still being compounded. It's still earning a dividend, right? It's the best thing since sliced bread. I love sliced bread, by the way. So let's move on. So let's look at this. This is an actual client of mine, all right? Can you guys see my screen now? Does it say Debt-Free Life Bank? Yep. Okay, because this is an actual illustration from a client of mine. They are now 4 years into this program. When I met them, this was their debt. And I know this is kind of small, but I'll read you the numbers just so you can see. But this was a 36-year-old man who was in debt, scheduled debt, for 40 years. Why 40 years? Because he had student loans. Actually, his wife had student loans. Okay. That's a long time to be paying off debt. I asked him when he wanted to retire. He said at age 75. Why? Because he wasn't going to be out of debt until age 75. Okay. It's a hard pill to swallow, right? And it didn't need to be that way. So this is what our system did. When we look at their real debt, it's $584,000. They have 2 houses. They have 2 cars. They have a bunch of credit cards. They got some back taxes. They got a bunch of student loans, right? The total principal amount that they owed came to $584,000, $585,000, right? Was that their debt? No. Why not? Because scheduled interest is going to kill them. They had $182,000 of scheduled interest. That means their real debt was $767,000, which is why it was going to take them 40 years to eliminate this debt. Okay. So what we did is we looked at a debt snowball, not a debt stack, not a debt avalanche, a debt snowball. There's only one best way to pay debts off in a very specific order, right? That's a debt snowball. And here's what we did. We repurposed or rescheduled their debts so that this is the fastest way that they can to get to debt elimination. I'm not consolidating. I'm not doing debt negotiation. I'm not going to call the carrier and say, hey, look, I know we owe you $3,000 and we haven't paid you in 2 months. If I give you $2,000 now, can we call it even? That's not what we do. You're going to pay your debt off, all of it, right? All those other programs like that, they're going to destroy your credit score. We are not going to destroy credit scores. Actually, as an end result of these programs, our clients usually crawl up to above an 800 credit score within about 24 months. Okay. But the truth is, once you got a private bank built, you don't need to go to the bank to borrow money anymore. Your credit score becomes irrelevant. Anybody ever tried to borrow money when you need to borrow money? What happens? If they'll give it to you, they're going to charge you a crazy high interest rate. Anybody ever not needed to borrow money and see what happens? You get inundated with credit offers from credit cards and banks, right? They want to lend you money when you don't need it, and they will charge you through the nose when you do need it, right? So I say, let's give the banks the middle finger. Let's tell them, yeah, I don't need your money. And that's what this program does. I saw you get that smile, Ruth, right? All right, let's keep going. So here's the money shot, right? So let's look. So they were on track to be out of debt in 40 years. They had $182,000 of scheduled interest. In the process of eliminating their debt on the schedule that we created for them, without them spending any more money than they were spending to start with. Okay, that's a key thing here. I know that if I create a new bill for somebody, they're not going to stick with it. Okay, so this is no more money out of their pocket than they were already spending. That's the nature of a debt snowball. We eliminated their 40 years of debt, $587,000 in 7.8 years. They are now 4 years into this program. They will be out of debt in 3.8 years. We saved $78,000 of scheduled interest. Let's talk about that for a second. If I could save you $78,000 of interest, where do you think that money would go? Well, maybe you're taking trips. Maybe you're buying toys. Maybe, if you're smart, you're saving it and you're using it for retirement. So we supersized their retirement. Really? Yep. So where they were on track to be out of debt in 40 years. They were going to have 100% equity in 2 houses, and they were going to have Social Security. With this program, in that same 40-year period, they'll be out of debt in 7.8 years. They'll have 100% equity in 2 houses. They'll have Social Security. And do you see that last number down there? They will also have $4.8 million liquid cash sitting in their private bank that they can do anything they wanted to do. Can anybody retire successfully on $4.8 million? I think I probably could, right? Okay. So now let's see how it really fleshed out. Each one of those yellow bars you see on your screen, that's a year in which we were paying off their debt. So if you look at where they are right now, they're in year 4. They've paid off everything that they were going to pay off in years 1, 2, and 3. So that means they're left with 3 debts: 2 houses and student loans. Student loans are evil, people. Got to say that. Say that every time, right? So let's look at this. So where they are right now, at the end of year 4, which is coming up in October, at the end of year 4, there will be $91,000 sitting in their account. This is the dangerous period for this family. Why? Have you ever noticed that people, when they win the lottery, are usually broke in about 3 or 4 years after they win the lottery? Have you ever noticed that professional football players, when they leave the NFL, are usually broke 3 to 4 years after they leave the NFL? And the reason why people become broke is because all of a sudden they've got a lot of money, but they don't know how to spend it. And they spend it on silly, frivolous stuff. They're not doing it. They're not following the system. If this family follows the system, they won't have to wait until he's 75 to retire with $4.8 million. At 55 years old, he'll have $1.5 million. Do you think he could retire with $1.5 million liquid cash sitting in the program? Probably so. $1.5 million is going to generate close to $200,000 a year of income. Could they retire without any debt? Could they retire with $200,000 a year coming, whether they get out of bed or not? Is their life going to be happier at 55 and completely retired versus 75 and completely retired? Are they going to be able to go live? So hopefully you got what I was just throwing out there. This is freedom, right? Unfortunately, we are given an opportunity to get into debt too early. Every time we have a new life event, we're given an opportunity to get into deeper debt. We turn 18, we go to college, we buy a car, we buy a house, we get married, we put braces on our kids, we send our children to college. It's just debt after debt after debt after debt. They make it really easy for us to get out of debt. They do not make it easy for us to get out of debt. That's what this program is. Okay. So what we did for this gentleman, he's actually not going to even hit 55, because all these years where this cash is growing, they're not just going to let it sit in here. They're going to make the money work for them. They're going to do something we'll talk about a little bit later today, but they're going to do a drip annuity campaign. So we're going to turn this $175,000 into about probably $1 million in about 6 years. So he'll have $1 million at age 49. He'll have 1.7 million, 1.5 million at year using a derivative annuity before he turns 50. Okay. All right. So that's the end of that illustration. These programs don't require debt, but if you have debt, the programs work faster. The next thing, I'll do this one briefly. What about if you have somebody who doesn't have like the big debts? Like the only thing they have is student loans. Well, let's talk about this. This is a client of mine that we did about the same time, 4 years ago. And this is where she was at 23 years old at the time. She had 40 years worth of debt already at 23 years old. She was just entering the master's program at Cal Poly. And she was in a bad space. So what we did is we structured one of these programs. Remember, this is a college student, not a lot of money, doesn't have a lot of money to use, has a lot of debt already. Okay. So in the grand scheme of things, that's not really that bad. To be 23 years old and be $177,000 in debt. Does anybody else besides me think that's not that bad? Yeah. Well, actually, that's horrible. 23 years old, $177,000 in debt. Okay. Well, it's not really 177, it's only 85. Okay. 23 years old and $85,000 in debt. Is that it? Is that better? Not right. So what do? We organize a plan. The majority of her debt is from student loans. Did anybody see the interest rate? That's a 6%, or that's a 4.45% interest rate. That's actually a little bit low, especially if someone's taken student loans, consolidated them, and moved them into another program. It's actually about 6% is what you see as the norm. So she got a good deal. But one other thing I want you to pay attention to: do you see that the almost last loan that get paid off, that Parent Plus? Do you know what that is? Her parents co-signed on the debt. Her parents are also responsible for this. So that means her parents' retirement is also being affected by her decision to take student loans, because they wouldn't give her the loan unless the parents co-signed for her. There's a lesson there for all you folks. Love your children, help them out. Don't sign off on their debt. They have more time to figure it out than you do. Don't do it. All right. So her program, she was going to retire at age 65. She used $91,000 of scheduled interest, going to be debt-free in 40 years. So she would be 63 years old, completely debt-free. Not bad. With our program, she got out of debt in 10 years. Let's talk for a second about how important that is. If you have a student loan and you're in deferment, the student loan is growing. Deferment doesn't mean the interest stops. It just means the payments stop. Okay. So if we put you in a situation where you can start making payments on that loan without putting it in deferment, you're going to save yourself thousands and thousands of interest. And that's what this program did for her. We eliminated all of her debt, including $94,000 of debt in 9.7 years on a waitress's income. Her source of income is to work as a server. Not that it's a great vehicle. It's a lot of people make a living that way, right? She doesn't have a lot of income. So $350 a month is all she could afford. So with $350 a month, we got her out of debt in 9.7 years, saved her $64,000 of interest. And at 63 years old, if she wants, she will retire with $600,000 in this program. That's the effective compounded interest. Okay. So these programs are incredible. Oh, by the way, that was with her stopping paying into the program at age 56. So if she wanted to at age 56, there'll be $400,000 in the program. Not bad. That's assuming she doesn't ever get another job doing anything more than a waitress where she can afford $350 a week or $350 a month, right? Not going to happen. So that's the end of this presentation. So where we go from here is we're going to have a conversation about some advanced stuff here in just a second. But if you were invited here by somebody, whoever invited you, your next step should be to get up with them. Find out how this program can work for you. Ask them to create one of these, structure one of these programs for you, okay? There's no point in hiding debt if you have debt. And there's no point in leaving debt off. You should incorporate everything into this. There's no one size fits all for everybody. Every single one of these programs is unique for the individual. Everybody's capacity to pay debt is different. Everybody's goal is different. Everybody's retirement horizon is different. Okay, so each one of these programs is unique to the individual. So make sure that you're completely open and honest with whoever brought you here. Okay, so I'm going to go ahead and, if you guys want, let's see if anybody's got any questions. Hi, Ruth. Nice to see you.
Hi, Scott. I'm right here.
Yay! Oh, look,
Yeah.
Mr. Taylor's with us.
Yeah.
Mr. Weaver. So Donna's question is, what are the risks? Okay, so let's answer that question. So the risks of these programs are that you don't follow the program.
Right.
So I've seen these programs fail, but the only time they fail is when you don't follow the program. So here's the biggest danger. These programs are flexible. And I said this earlier on. We all know and understand life happens. Things happen, right? All of a sudden, who knows? Maybe you drop the transmission in your car. You need to go get a new transmission. That's life. It happens, okay? It's okay. These programs are flexible. The problem that I can see is because they are flexible, all of a sudden people say, oh yeah, it's working, it's great. Let's reduce the amount of money we're paying into the program. And then they become surprised when all of a sudden the next debt they were supposed to pay off was going to be in 2 months, but now there's not enough money to pay the debt off because you're not funding it correctly. Remember, these programs are structured so that we're not spending any more money than you're spending right now. We're looking in places where you're spending money inefficiently. So let's talk about that for a second. Where you spend money inefficiently? Life insurance, overpaying debts, saving money in a savings account, overfunding your retirement program beyond where the match can come from, putting money in a coffee can in your backyard. These are all places where you're saving or storing money inefficiently. Why in the world would you put money in a savings account earning 0.25%? Thank you, Bank of America, when you could go put it into one of these programs and earn 12 times that? Because the minimum is 3%. So it doesn't make any sense if you have liquidity, if you're saving money, if you got money on the sidelines, it doesn't make any sense to leave the money there. You should put it into one of these programs. You still are liquid. You still have access to it. Okay. So our goal is to find places where you spend money inefficiently, repurpose it and use it to help you eliminate your debt, get out of debt quickly, start building your nest egg, start building your retirement program. Oh yeah, let's talk about that for a second. There are no risks taking money from the program. You can take money anytime. So the minute you make your first payment, the minute there's a cash value in the program, you can take cash out. Don't follow your plan, get out of debt first. Okay. That's the key. Other than that, there is a danger if the cash grows too fast. like if you try to fund it beyond what the maximum capacity is, there is a danger that the program can become a modified endowment contract and become taxable. There are logical reasons why sometimes you want to do that. And I can't tell you what they are right now. They're on a case-by-case basis, but there's some reasons why you may want to do that. Okay. Let's see. I currently have a prospect who's interested in DFL, but he is a New York resident. Are there any? So yes, there are companies that offer this program in New York, and they are not companies that Symmetry contracts with. So one that offers it. Let's see. So you wouldn't want to fund with large sum. Well, actually, exactly the opposite. If you had an opportunity to put a large sum of money in here, the sooner you do that, the better off you're going to do. And that's because of the nature of compounded interest, especially if you're using a company that does monthly compounding as opposed to annual compounding. On an annual compounding routine, it doesn't matter when you fund it. But on a monthly compounding, so if I put $100,000 in here on day one, that means I've got 12 months of monthly compound. Monthly compound one. Monthly compound two is a compound of the initial plus the monthly compound. Monthly compound three is a compound of month one compound, month two compound, and the initial. So you get 12 months of compounding the compounding the compounding the compound. That is the best way to do this with a monthly compounding company. All right. Where can I read about debt-free IBC? There's all kinds of stuff on the web. You can take it with a grain of salt. There's a lot of charlatans out there. Look to somebody who's got some good reviews. If you get bored, you can I have a YouTube channel. You can go to the YouTube channel. You can subscribe to it. There's lots of these training events that have been recorded and up there. Other than that, if you're part of Symmetry, then we have debt-free life training events at Symmetry that teach you how to do this. Other than that, there's, I think, 2 or 3 other training companies out there that teach different versions of this program. You can go do that. Website, keep losing connection and can't hear anything. I don't know what that means. Okay.
Scott, there's a question that keeps coming up. Once you've paid off your debt, where do you go from there?
Gotcha. So that's the beauty of these programs. They're flexible. So it depends on what you're trying to do. All right. So once you've paid off your debt, do you want to continue contributing to the program? Maybe, maybe not. Do you want to start leveraging the program and do a drip campaign that drips money into another investment? That's what I do. That's what I would do. Okay. What kind of investments? There's all kinds of stuff. So, maybe, and I'm not advising anybody to invest in anything. Okay. This is not financial advice, but there's lots of things that you can do. You could do an annuity drip campaign. You could drip money from this into another infinite bank, and you could chain the infinite banks together. You could take this money and create a business model for yourself. I have a client in Montana who uses this. She puts money that she was normally saving because she's a hard money lender. She lends those contractors money to go out and do flips, right? And she charges them 16% interest. She leaves her money in her bank, in her regular Wells Fargo, Bank of America, whoever she banks with, okay? And then she pulls the money out and lends it to them at a high interest rate that's secured with the real property. Great model, right? Well, what if I could lend the money and still earn money with the money? Because when she takes it out of that savings account, she's not earning anything with it. So that's what she's doing with this. She puts the money in here. She's got $1 million in the program. She takes out $100,000 for the flip. It's still earning interest in there. And then she lends it to the other person over here. And now it's earning interest there. Right? So there's lots of different ways you can do this, lots of places you can put the money. It just depends on what you want to do. All right. Did I miss anything else, Ruth?
Yeah, I think there might be a little bit of a confusion. It says if I'm getting 3% monthly compounded interest, what does that work out to an annual basis?
Gotcha. So yeah, so I never said it was a 3% monthly. It's a 3% annual compounded monthly. There's a difference. So 3% annual compound, if it only compounds once a year, that means you're earning 3%. 3% annual compounding monthly potentially you're earning 3.6, 3.7%. And all that can be influenced with a monthly compounding vehicle. That can be influenced by when you put the money in.
And then other than having debt, how much money do you need to put down for a DFL program, or what are the requirements?
So the amount of money you put into the program is individually determined. Because remember, our initial focus is on debt. So our goal is to figure out where you're spending money inefficiently. So I would say if you've got money sitting on the sidelines, that should go in as soon as possible, so you can start earning interest with it, way more than you've got right now, right? But if not, then you just start off. We look at places where you're overspending. So the typical program that I find is going to be between $200 and $600 a month of money that's spent inefficiently. Okay. If the person's younger, it's going to be closer to 200. If the person's older, it's going to be spent closer to 600. So there is no one size fits all. Like I said, we look at the program and create it so that it fits the budget that the client has, without trying to put them in a situation where they're spending more. We don't want to negatively affect their cash flow on a monthly basis. Okay. What else we got?
Yeah. Can the DFL IBC program be designed using IULs? This is a great question because there's a lot of confusion about this. So I'd love for you to be able to respond to that for.
Sure. All right. So the short answer is yes. The much longer answer is it's a really, really bad idea. And the reason why is because the purpose of these DFL programs is to get people out of debt, have a known date when there's going to have a specific amount of money, have a known date when we're going to be debt-free, have a known date when we're going to be able to start drawing income. All those things are knowns when you're using a participating whole life. In an IUL, you have no idea what the return is going to be. In an IUL, there's typically a reduced access to cash value early on. In an IUL, if you have 2 flat years in a row, you're never, ever going to catch up to the performance in something that's got guaranteed growth every year, whether the market goes up, down, or sideways. So for me, and the way I was taught and the way I believe, IULs should never be used for these programs. There's too much variability in their return. Hopefully that answers your question, whoever asked that question. All right, what else we got, Ruth?
And then last one so far, FDIC insured ?
Right. So FDIC is a banking insurance product. So the Federal Deposit Insurance Corporation insures monies on deposit with a bank, and the monies on deposit in a bank is up to $250,000, regardless of how many banks you're in. So if you've got 250 in 3 different FDIC banks, you're only insured for 250. You're not insured for 750. The credit version of that, credit union version, the NCUA, the National Credit Union Alliance, again, it's the same thing. You're insured for $250,000 across however many you've got. So if you've got $5 million at $250,000 a piece into 20 different credit unions, you're only insured for $250,000 total. Okay. So the question that should be asked is, what's the insured value here? Okay. And so here's the beautiful part about these programs. These are programs that are offered through the most stable companies on the planet. These companies, in order to do business in any state, they have to agree to co-insure other insurance companies that do business in that state. So while I may have written the program with a mutual company, mutual blah, 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 financial blah, 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 and prudential blah, 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 and a surety blah, 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 all those other companies have to co-insure that policy. And they're not limited to $250,000. So they're limited by the capacity of the general ledger of the underlying company to perform. And since these are highly regulated companies, there's no way in the world the insurance company can offer this product without having enough numbers, without having enough cash liquidity to be able to ensure the ability to perform on that contract. More importantly, this is where ratings come in. So you have different insurance company ratings out there, A, B, C, D, E. and there's different, like Moody's, right? You can go look up any company and go see what insurance company ratings they have. And if the company's not an A-rated carrier and you're trying to do one of these programs with them, run away. So that's why what we do here, what we teach, we only use A-rated carriers, because we want to make sure that if something crazy happens, that our client's going to be supported and taken care of. All right, what else we got?
That's awesome, Scott. You're rocking these questions out.
Yeah.
That's all we got so far.
Yay, you stumped the forehand. All right, great stuff. All right, so we do an advanced topic training on these events. How much time do we have? We got about 20 minutes. Okay. So should I have anything in writing as to protection? I'm not sure what you mean by that question, Trader. Trader, you want to unmute and speak your question? Oh, you're already unmuted. Go ahead and speak.
Yeah, so my question is, normally, as with the banks, you've got $250,000 in protection on any given, I guess, across the board.
Sure.
And that was something I did not realize. So I absolutely learned that today.
Okay.
But what I'm saying is, so say I've got $200,000, $300,000, $400,000 in this account, whatever the number is.
Yep.
What is my guarantee that if something happens, that
Right.
I would be protected?
Okay. So you actually have 4 different entities that are insuring the value of that policy. Okay. Entity number 1 is the carrier that originally underwrote the policy. Entity number 2 is every other carrier that does business in that state, that has authority from the state to do business in that state. Entity number 3 is the state itself in which the policy is issued. And entity number 4 is the state in which the underlying carrier is domiciled. So this is an insurance product. You're safe every which way from Sunday.
So the money that's in the account is never ever really considered to be a savings account so much as insurance money.
Let's be real. Okay.
And
that is absolutely, let me clear this one up before, because I want to make sure. It is never the case that this is a banking product. This does not exist under banking law, which is why we can do the things that we can do with the taxation. Okay. This exists under contract law. Okay. So I don't know if you may or may not have been around a couple of years ago when Obama was president and AIG was a company they were going to bail out, and then they bailed them out, and then everybody got angry because all the executives that caused AIG to get to that point where it had to be bailed out were given all these golden parachutes. And that question was put up there that, why are we doing this? Why are you allowing them to do this? And the reason why is because that's a contract, and the federal government does not have control over contract law. And any contract that's written is governed by the laws at the time that the contract was struck. Okay, so that's why the federal government doesn't have any control over this. It is not a banking instrument, it's a contract law instrument. And so it's not a savings account. If it were a savings account, then you got a different set of issues. You can't borrow money from a savings account and still earn interest on it. That's why this is the investment vehicle of the century, because you can't. You can put money in the program. You're not putting money into cash value. It's considered cash value by the carrier. You're putting money into a life insurance product. You are buying additional life insurance. The carrier is considering the value of the additional life insurance that you've paid up as investment money that they can use, and they do. And they invest it. They will. And they make a lot of money with it. They will. And they don't pay you everything they make with it. They pay you a portion. Okay. They may make 16 or 20% and they pay you 3. Okay. But it's not considered cash. So this is another one of those things when we look at, like, for example, when we're trying to get a client qualified for student loans or for a grant, right? If they've got $200,000 sitting in a checking account, they are not going to qualify. They've got enough money, they can pay for the college themselves. But what happens if I take that $200,000 and I put it into one of these private infinite banks? It's no longer cash. It is now life insurance. Life insurance is not reportable on the FAFSA form. I just got $200,000 taken off the books so that that person can now qualify for a student loan. So these are different ways how this can impact. I didn't mean to step on you, trader, but that's
Nope.
this piece. So hopefully that answers some of your question, but keep going if you have more.
And so worst case scenario, I could, if 5, 10, 15 years down the road, I could take all of the money out of the account, the money that I contributed, the interest that it has earned, cancel the policy, walk away with no tax indebtedness.
Well, as long as the program hasn't become a mech, then the answer to your question is yes. I don't know that you'd be able to take all, because with every program, with these programs, when they get issued, there's a clause in there that says guaranteed interest rates, compounded interest, and dividends will not be paid in a year where the policy is canceled. So if you think that you've earned, because you got a lot of money in there at that point, if you think you've earned $10,000 or $12,000 of compounded interest and dividend, it won't be credited to you at the time that you take it. And there always will be some fee associated with the surrender of the policy. I don't know what that is, but it's usually not. I mean, we're talking about 10 years of growth. It's pennies, but you should, in that scenario, be able to capture more than you put in as the initial cash. Because don't forget, when we're looking at the cash value of these programs and the surrender value, there's a thing called cost basis. So when you're contributing to the program, there's a fee associated with the whole life component and the term life rider. Those fees are keeping your death benefit elevated so that you can grow the cash underneath. So those fees, when you're computing your basis, those fees, the cost of insurance should be enough that you're not going to have a taxable event. I understand your question, but I do find it difficult to answer with a blanket statement that there won't be a taxable event, because it probably not. It just depends on how it's been funded.
Okay, so on the other hand, let's say that I have, let's say I'm sitting on $75,000 between the money I have contributed and the interest it has earned.
Okay.
And I want to withdraw that $75,000 for whatever reason. And so I don't cancel the policy.
Then you're taking
and I don't significantly pay back the loan. Where do I stand at this point?
So in that case, you're taking a loan, and where you stand is hopefully you haven't encumbered that policy. You've left enough room in there that the guaranteed interest rate and the dividend are going to pay down that loan for you over time, which is usually the case. You're asking a hypothetical. I can't answer definitively how it will always be, because there's no definitive answer. Every one of these cases is different. So, if you're pulling out 75, how much do you have in there? Is there 95,000? Is there 105? And you're
well, no. The question was actually that I had 75,000.
And you want to surrender the policy?
So that would be essentially what I would be doing, is surrendering the policy if I tried to borrow all of the.
Right. So I maybe probably.
I don't know. You're the expert here, and I'll be honest with you, you're going a little fast for me. I'm pretty good with numbers, but I'm not that good with insurance.
Okay.
So a lot of what you're saying goes.
I mean, if we're talking about hypothetically, it shouldn't be an issue. There's also the RPU option. So the RPU option allows you, the death benefit is always going to be higher than what your cash value is if they're structured correctly and non-MEC. So therefore, the death benefit should be higher than what you take out as a loan. And if the death benefit is higher than what you take out as a loan, the death benefit secures the loan. So if you take out 75,000, it's because your death benefit is much higher than 75,000. So what happens there? If you don't close out the policy, the cash value that's still in there, because you didn't take your cash out, you took a loan, the cash value and the dividend may be enough to pay the debt service on the loan that you took. If not, your policy will slowly degrade over time. How long?
Let's say the policy's worth 125 and I take out 75, so I've got 50.
Right. So when you die, that $75,000 loan, if you never pay it back, might still be there. It depends on how long you live. Again, these are all hypotheticals. So the best case, no offense to you, man, but best case scenario, you die the next day after you take out that loan. And then what happens is the $125,000 death benefit pays the 75 off, and the $50,000 goes as a legacy to
Oh,
your
no,
family.
no. What I meant was I had $125,000. I took 75, leaving 50.
Okay. So now you're talking about the math. So the math of where's the sweet spot of how much you can borrow. Okay. That math, depending on whether you're still contributing or not, is a component. But if you're not contributing, then so here you go. You have 125,000, 125 times 0.03. So you're earning $37.50 per year in interest, guaranteed interest. 0.025 times 125. You're earning another, so you're earning about just over $4,000 a year in guaranteed interest and dividend. Okay, and you borrow 75,000, and let's say the interest rate is 0.0385. That means your loan interest is 28.87 per year. So your loan interest is 28.87. The guaranteed interest that you're earning is 4,000. Congratulations, you're executing the program correctly. You have just created positive arbitrage. So you're earning $4,000, paying $2,800. The balance is either growing the cash value of the program or paying the loan down. Either way, the debt service is paid.
And then a year after I take this loan out and I haven't made any payments on it,
The same thing happens again.
I expire, so that the $50,000 would be claimed to pay off my loan.
Yep. So
who's responsible for the other
So let's-
25,000 that's left?
Let me answer this one thing first. In all cases, every loan will get paid back. One way or the other, every loan gets paid back. All right. So the loan is either going to be paid back because you're doing a process called dollar cycling, where you're paying into the program, actively paying into the program. So the cash value component of what you pay in is either going to build more cash value or close down loan debt. That's one way. The second way it gets paid off is the guaranteed interest rate and the dividend come in and pay the loan off for you over time. The third way it gets paid off, the death benefit pays the amount of loan at the time of death. It's the same way with an IUL. It's the same way with any kind of annuity product. The death benefit is going to get paid by the debt's going to pay the cash value, or the death benefit is going to pay the loan off first before any of the money is distributed to the family.
Okay, but in the event that I'm talking about, I die, I have $75,000 on a loan. I have $50,000 of insurance left. So there is a $25,000 deficit. I'm assuming that 50 is going to go towards the 75.
Yeah, that'll never happen. You're never going to be able to borrow more than your death benefit.
Oh. So in other words, I could borrow 50,000 of $100,000 policy and have, or 49 and have 61
so
left.
there's a disconnect in how this program
51.
works. So when you're buying paid up additions, you're buying death benefit. Okay. The paid up additions are considered cash growth. Okay. So you can never have, unless it's a MEC, you can never have more cash value than the death benefit.
What is a MEC?
Modified endowment contract. Okay. So that's something we try to avoid, because that makes the whole program taxable. Okay.
So I can't borrow more than the total value of the package to begin with.
Right. Yeah. This doesn't create money out of the air.
Right. They're going to get, if I die, then they're going to have capacity to take the money that's left from my death benefit and zero the.
Your paid up additions act as collateral for the loan.
You're just trying to understand. Not saying I'm going to do something like that. I just want to understand how it works.
Right. All right. So
you're the insurance guy, and insurance isn't easy. You know, it's easy once you do it and do it and do it. By the time you've made your 200th sale, I'm sure it gets quite a bit easier. But
yeah, I think you guys are saying the same thing, just saying it a little bit differently. So you Jonathan made some good points in the comments there. You're never going to be allowed to borrow more than the death benefit. So you can borrow up to 90%.
Okay. Yep.
Thank you.
No. Yep. Go ahead.
Anybody else has a question, I'd like to give somebody else a little bit of time. I don't know who Trader is, but if you reach out
I spoke with you a
online,
couple days ago.
okay,
And I apologize because that just that's the on my Zoom. That's the actually the computer was it's a custom computer and it just came through and I am a trader, so not like Benedict Arnold.
well, let me ask you a question, Trader. What's your name?
Oh, Mark Palmer.
Oh, I know who you are. Hi,
Nasir,
Mark.
yeah,
Nice to talk to you.
Nasir called you.
Right. Very nice. Nice to talk to you, buddy. All right. Does anybody else have any questions? Okay.
No question. No question. I did have one quick comment. You were mentioning about how these things are beneficial when you've got kids in college.
Yep.
About 3 weeks ago, we did 2 financial aid forms for my kids, and they were kind of shocked when I asked them if they could put a negative number in the net asset value on it. You can't, by the way, but you can put a 0. So
Okay.
they're happy. They're getting qualified for some nice financial aid.
Thanks, Tom. Nice to see you, by the way.
Good to
Okay.
be seen. Sorry I was late. I had a DFL appointment that got off to a late start. So
Okay.
that's why I was running late.
All right. Anybody else? We don't need to go all the way to 7 o'clock, and there's not enough time to do one of those advanced pieces here, so we can just have a quick conversation. And anybody else? All right. Well, thank you everybody for coming. Hopefully you got something out of this. You guys have any questions, reach out to me. Ruth, you became an unwitting co-pilot here, so thank
I
you.
loved it. I loved it.
Right on. Any questions for you, Ruth? Any comments? Tom, Ruth?
Really
Scott?
amazing questions tonight. Really
Oh,
good
yeah.
questions.
Yeah.
No, I love listening to this every time, Scott. It's empowering. I love hearing you just say it so perfectly easily and all of that, but it's awesome. So
I see Dr. Kuhn has joined us. Dr. Kuhn, good evening. How's Texas?
It's getting warm again already. That's like 88 degrees, 90
You
degrees.
can keep
today.
that.
It was
Yeah.
88 here today.
Yeah.
It was really warm.
Yeah, me too. But it's good stuff, Scott, as usual.
All right. Well, thanks, Dr. Kuhn. All right, everybody. We'll be doing the radio show live this Saturday if you get bored, 9 a.m. And then next week we'll be back doing this again next Thursday. If you want to come to that, let us know. If you're in the invite list, you'll get an invite like we do normally. So I appreciate everybody. Go out and again, as before, whoever invited you here, get up with them if this is something that interests you, and have them help structure one of these programs for you. And I wish everybody the best. Bye.
I really appreciate it, Scott. Thanks.
Hey, thanks
I'll
for
be pursuing this.
Thanks for coming.
Thank
Bye,
you.
everybody.